dear friends. In this video, we will see how to prepare the income statement under marginal costing and absorption costing and reconciling the two profits. To understand this better, we will take one question. So question number 25. Eagle makes one product, budgeted production and sales for the year just ended. Budgeted production for the and sales for the year just ended were 32,000 units. Actual sales for the year were 34,000 units at the selling price of $34 per unit, and the actual production was 36,000 units. So sales 34,000 units, production 36,000 units. Opening inventory was 5,000 units valued at the unit cost of the preceding year. So we know for the year just ended, for this year, budgeted units, we know 32,000. For the year just ended, budgeted units were 32,000 units. And for the actual, when you see, they have produced 36,000 units and they have sold 34,000 units. And they also told you that 5,000 units were opening stock. So we know opening stock plus production will give you the total number of units available for sale. From this, if you minus whatever is sold or sales, you will get the closing stock. So opening stock in units, everything in units I'm saying, opening stock 5,000 units, you produced 36,000 units. So the total number of units available for sale is 41,000 units. Opening stock plus production, you get 41, and 41,000 units are available for sale. Out of these, you sold only 34,000 units because actual sales were 34,000 units. That means 7,000 units are lying as closing stock. So the closing inventory, you have 7,000 units. Okay, that's what we have understood from the first part. Using an absorption costing system based on budgeted levels of output, unit cost for the year and the preceding year were as follows. So they have, for the budget, for the year, budgeted units is 32,000. They have computed whatever the budgeted variable cost, fixed costs and all. And they have also given you the preceding year's figures. Okay. And then they are saying, here you have prime cost, variable production overheads, fixed production or overhead, selling and administration overheads. This is completely fixed. And the total cost, profit and the selling price. Okay, so selling price per unit is $34. Preceding year, it was 30. So fixed production overheads for the year just ended were the $48,000, and it is budgeted and actual both are the same. Fixed production overhead for the year just ended were $48,000. Budgeted also 48,000 only, actual also 48,000 only. That's what they have mentioned. Actual variable cost per unit were the same as budgeted. So actual variable cost per unit were the same as budgeted. Actual variable cost per unit were as same as budgeted. So this is what is given to you. We will prepare the income statement under absorption costing, marginal costing, and the third one, we will also reconcile the profits. We'll also reconcile the profits. Okay, so we will see how to prepare. So first, I would like to prepare income statement under marginal costing. Under marginal costing, how do you prepare the income statement? We take the sales minus the variable cost. You will get the contribution minus the fixed cost and you get the profit, right? This is the format. Income statement under marginal costing, you take the selling price, sales, minus the variable cost, you get the contribution, minus the fixed cost, you get the profit. So we will first prepare the income statement under marginal costing. So how do we do this? So Eagle income statement under marginal costing. Selling price. What is the selling price? How many units are you selling? How many units are you selling? You are selling 34,000 units, 34,000 units, and the selling price per unit is 34. So 34,000 into 34. So this is your total sales. So from the total sales, you have to minus the variable cost of the goods sold. So selling price minus the variable cost. So we have to take into consideration all the variable cost. So remember, we had opening stock in the sum. So opening stock, we know what is the opening stock. Opening stock is 5,000 units. Okay, 5,000 units. If you read the sentence, it says opening inventory was 5,000 units valued at the unit cost of the preceding year, because this opening stock was not produced in this year. It was produced in the preceding year, previous years, whatever produced and whatever unsold, that becomes the opening stock for this year, correct now? So they have said it should be valued at the unit cost of the preceding year. So what is the unit cost? Because it is marginal costing, inventory will be valued at variable cost. Fixed cost will not form part of the inventory. So in marginal costing, what you take into consideration only the variable cost for inventory valuation. So 5,000 units was the opening stock, and this should be multiplied by 23 because the variable cost of production in the preceding year was 23. That is 22 plus 1. So inventory, opening inventory. So this is the value of goods that you had at the beginning, 5,000 into 23. So this is the value of opening stock. Now in the current year, how many units did you produce? You produced 36,000 units. And to produce 36,000 units in the current year, what is the total variable cost? So total variable cost is prime cost plus variable production overheads, that is 24 plus 3.5. 24 plus 3.5 will give you the total variable cost for the year, for the current year. Therefore, it is 36,000 units you produced, and the variable cost per unit is 37.5. So variable cost of production is 9,90,000. So what is the total variable cost including the opening stock? So opening stock is this, and the units that you have produced is this. So total value is 11,05,000. But the entire 11,05,000 you have not sold. All the goods were not sold. You had not sold 7,000 units because you know the closing stock is 7,000. Opening stock plus production is 41,000 minus the sales will give you the closing stock. So closing stock, you still have 7,000 unsold goods. Do you understand? So that value you have to minus it. So if you minus 7,000, so here what we assume is the inventory. Whenever nothing is mentioned, we will be following first in, first out method. So the opening stock, that is the old stock, will be sold out first, and then from the new production. So the closing stock will comprise of the latest produced goods only. And the latest produced goods value is 27.5, because 27.5 is what is the cost here. See, 24 plus 3.5. This is the variable cost of production. So the closing stock will be from the new production and not from the old production, because we assume if nothing is mentioned, first in, first out method. So the old stock will be sold first, and then only we will take the new production. So the closing stock will comprise of the latest produced goods, right? So what is the value of goods that you have sold? It is 9,12,500. So opening stock 1,15,000, variable cost of production 9,90,000, total you get 11,05,000. Out of this 1,92,500 you have not sold. So variable cost of goods sold is this. In case if there is any variable selling expenses, there is no variable selling expenses given in the question. Selling expenses is completely fixed. But if at all you have any variable, you have to add here. Okay, so the total value will be this plus this. So 9,12,500. So you know that selling price minus the variable cost will give you contribution. So contribution earned is 2,43,500. From the contribution, you need to minus the fixed cost. So fixed cost, what do you minus? You must find out what is the production expenses. Production expenses. Production expenses, they have given you production fixed production overheads for the year just ended. Actual and budgeted is the same. So 48,000 is the actual production overheads. So actual production overheads is already given in the question, 48,000. And what about the selling? Selling overheads, you know, it is fixed, is 1 rupee, and the budgeted units is 32,000. So 32,000 into 1 is 32,000. So this is the total fixed fixed selling and administrative overheads. This is the total fixed cost. This divided by 32,000, they have given you as 1 rupee. Did you understand? So the actual selling and administrative overheads is 32,000. 32,000. So that 32,000, you will take it here. Okay, so this is the budgeted, this is the cost. This divided by 32,000, they have got 1. And you know that since you produced 36,000 and you have sold 34,000, fixed cost will remain fixed. You can't write 34,000 into 1 because this is the fixed fixed overhead. It will not vary because the word fixed is there. It will not vary depending upon the output or the number of units sold. It will remain constant, whether it's 34,000 units you're selling or 32,000 units you're selling. So you cannot take 34 into 1. It is 32 into 1 because 32 into 1 is whatever for preparing the budget. This is the expense, fixed overhead. This is divided by 32,000 and they've got 1 rupee per unit. Do you understand? And when you produce 34,000 units, it doesn't mean that 34,000 into 1 because fixed overheads will remain fixed. So even when if you're selling 34,000 units, fixed selling overheads will remain at 32,000 only. And that's why 32,000 is taken here. So now you add these two and take it here. You will get the profit. So contribution minus the fixed cost will give you the profit. Contribution minus the fixed cost will give you the profit. So selling price minus the variable cost gives you the contribution, minus the fixed cost will give you the profit. Now moving on to income statement under absorption costing. Now in marginal costing, we will consider only the variable cost for the valuation of inventory. Fixed cost will be charged off as an expense in the period in which it is incurred. In absorption costing, it is not like that. We will consider the variable cost as well as fixed production overheads for the valuation of inventory. So that's a difference. So what happened, because you are including the fixed production overheads, fixed production cost in the valuation of inventory. So what happens is inventory under absorption costing will be more than marginal costing. Okay, so the total selling price is the same, 34,000 into 34. This is the total sales. So cost of production, you have to take the variable as well as fixed. Remember, you have to take the variable as well as fixed. So variable cost of production is how much? You are producing 36,000 units and the variable cost of production, you know, it is 37.5 because we have already done that. Variable cost of production is 24 plus 3.5. That is the variable cost of production. Now, you know that in absorption costing, you also have to take into consideration the fixed production cost. So fixed production cost, how do you do? So fixed production cost, what they have done, they have absorbed, they will be absorption rate is given to you. What is the absorption rate? The total cost is 48,000, that is the budgeted, and that divided by 32,000, they have got 1.5. See, 48,000 is the production overheads. Budgeted units is 32,000. So when you divide 48,000 by 32,000, you get 1.5. That's how they have determined this. So this is the absorption rate. So this is called the absorption rate. So for every unit that they produce, they have to charge $1.5 as fixed production overhead. So this is known as the absorption rate. Okay. But for every unit they produce, they will absorb fixed production overheads at 1.5. So how many units have they produced in this year? It is 36,000. So 36,000 into 1.5. So this is the fixed production overheads absorbed. So this is the total value of goods produced, total cost of production in other words. So variable cost of production and fixed cost of production, they have added both. We get total cost of production. And from to this, you also need to add the opening inventory. What is your opening inventory? Opening stock is 5,000. Now remember 5,000, and now we have to value at what is the value of 5,000 under absorption costing. Absorption costing, we don't take only the variable, we also take the fixed. So fixed production cost. So 22 plus 1 plus 3. So 22 plus 1, 23, 23 plus 3, 26. So this should be multiplied by 26. So this is the opening stock, 5,000 into 26. Remember, in absorption costing, we take the variable cost as well as the fixed production overheads for the valuation of inventory. So opening stock is 1,30,000, add it up. And from this, you need to minus the closing stock of finished goods. Now, what is the closing stock? Closing stock, 7,000 units are lying in stock. And this will be, we will be following first in, first out method. That means the closing stock comprises of the latest production. And what is the latest production cost? It will be 24 plus 3.5 is the variable cost plus 1.5, which is fixed cost. So 24 plus 3.5, 27.5, 27, 28, 29. Okay, so 29, 24, 27, 28, 29. So it is 7,000 units at the rate 29. So this is the closing stock. So what is the value of goods sold? It is this minus 2,03,000. This is the value of goods sold. So how do you find the gross profit? Gross profit is sales minus the cost of goods sold. So cost of goods sold, we have already calculated. Therefore, 1,85,000 is your gross profit. Now from this, you need to minus the variable selling expenses if there is any. There is no variable selling expenses. Fixed selling and administration overheads. So I told you fixed. So the actual cost is 32,000 into 1 because here they have given 1. So how many units budgeted is 32. So 1 into 32 is 32,000. Because it is fixed, even if your if number of units sold is 34,000, it's not going to vary. It will remain at 32,000 only. So that's why you take here 32,000. So the total selling overheads is 32,000 from the profit, gross profit minus the selling overheads. You get the profit before absorption adjustment. Now, please pay attention. This is the profit before absorption adjustment. Now, what does this mean? See, your actual fixed overheads is $48,000. Fixed production overheads for the year just ended was $48,000. But what have you absorbed? You have absorbed 54,000. So now that means you have taken more expense. You have charged more expense here. Actual expenditure is 48,000, but you have absorbed 54,000. Because you have charged more, your profit has come down. Okay, by how much? It'll be 54,000 minus 48,000. So 6,000. By 6,000, the profit is less. Therefore, to make it equal, to bring it to its original, you need to add back the 6,000. You need to add back the 6,000. If you add back, you will get the profit as per absorption costing. So we have calculated income statement under marginal costing and income statement under absorption costing. Now, how do we reconcile? Now, reconciliation is very, very simple. You know why the profits under absorption costing and marginal costing differ. Why it differs? Because of the valuation of inventory. Because inventory under marginal costing is valued at variable cost only. Whereas in absorption costing, inventory is valued at variable cost and fixed production overheads. So fixed production overheads or fixed production cost is considered in the valuation of inventory under absorption costing. And because of this, the two profits, you might find some difference. You'll find differences in the two profits. So how do we reconcile? We will see now. Now you have to determine, because you know the profit as per absorption costing is how much, profit as per um, marginal costing is how much, you know. So you have to decide which profit you want to start with. So supposing I want to start with marginal costing. Okay, so if I want to start with marginal costing, I will write marginal costing as the first heading, absorption costing as the second heading, and then I'll write here adjustment. So this was one small working note. Okay, so if you start with marginal costing, ensure that the first column is marginal costing. If you and then write absorption costing and then the adjustment. Okay, so in marginal costing, what is your stock? Now remember one more point, opening stock. Opening stock uh, Opening stock, if your opening stock is high, what will be the impact on profit? Profit will be less. So opening stock, if it is valued high, profit will be less. If the opening stock is valued less, profit will be more. So you must remember opening stock as an inverse relationship with profits. And what about closing stock? Closing stock, higher the opening closing stock, higher will be the profit. Lower the closing stock, lower will be the profit. So closing stock has direct relationship with profit. Opening stock has inverse relationship with profit. So this part you have to bear it in mind. So you compare the opening inventory. What is the opening inventory here? It is 1,15,000 under marginal costing. But absorption costing, see what is the stock opening stock is 1,30,000. So since opening stock in absorption costing is more, the profit in absorption costing. So I'll write here opening stock. Okay, because of opening stock, absorption costing opening stock is more. That means absorption costing profit will be less. Marginal costing profit will be more, because here you have taken less opening stock, here you have taken more opening stock. More opening stock means less profit, less opening stock means high profit. So what is the difference between these two? That is 1,30,000 minus 1,15,000. It is 15,000. So 15,000 you need to subtract if you're starting with marginal costing. You see this arrowhead. If the arrowhead is down, you have to minus. If it is up, you have to add. Now I'll see the closing stock. See, closing stock, what happens? Closing stock here in marginal costing, it is 1,92,500. And here the closing stock is 2,03,000. So closing stock is more in absorption costing. That means profit is more in absorption costing, because more the closing stock, more will be the profit. Here the profit will be less because you have taken less closing stock. So what is the difference between the two closing stock? Here it is 2,03,000 and here it is 1,92,000. So 2,03,000 minus 1,92,500 is 10,500. So 10,500 should be added. So if you do these two adjustments, you will reconcile the two profits. So profits under marginal costing, I'm going to take the profits as per marginal costing. It is 1,63,500. So add the fixed cost included in the closing stock. You know what to be added. What is added? 10,500. So 10,500 you add, you get this. And then from this you minus what? 15,000. So 15,000 if you minus, you should get the profits as per absorption costing. So absorption costing profit is 1,59,000. You got 1,59,000. Supposing instead of starting with marginal costing, if you have started with absorption costing. So in that case, I will ensure that absorption costing is the first column, marginal costing is the second column, and then the adjustment. Okay, so absorption costing, you see what is the opening stock. Opening stock impact, it will be whatever the arrowheads that you have here, it will be less here, and closing stock, it is more. Here it is more and this will be less, and you have to do the opposite. So opening stock 15,000. So 15,000 to be added and 10,500 to be subtracted. It'll be just the opposite. So 59,000. If you start with 59, that is profit as per absorption costing. You need to subtract 10,500 and then add 15,000, you will get what is the profit under marginal costing. Hope you have understood how to compute income statement under marginal costing and absorption costing and reconciling the two profits. Thank you very much for watching my video. Have a great day. God bless.